Welcome to Breaking News to Trading Moves. Today we're focusing on a headline that's certainly got people talking in the media world. Reports about unsolicited buyout interest for Warner Bros. Discovery.
That's right. It's a situation worth watching closely. WBD, they're looking into what they call strategic alternatives.
Which usually means they're considering anything from a full sale to maybe splitting up the company.
Exactly, or other kinds of restructuring. And this is all happening while they're juggling, I think, around $35 billion in debt. Quite a sum.
Definitely. So today, let's look at the material that's out there and see who might come out ahead and who might feel the squeeze from all this.
Sounds good. We'll stick to what's been reported, focusing on those immediate winners and losers.
Okay, so let's nail down the core fact here. Shares of Warner Bros. Discovery, that's ticker WBBD, they jumped right after these reports surfaced.
They did. News came out that they'd received some buyout interest, maybe just initial feelers, and that the company is, well, evaluating its options seriously.
And this strategic review, it's mainly about handling that complex structure they have now and that big debt number you mentioned.
Pretty much. The debt is a huge factor. So the alternatives could be a full sale, maybe selling off just certain parts of the business.
All right, let's talk winners. If a big media player steps in and acquires WBD, who stands to gain the most based on the reporting? It seems to point to a couple of key strategic buyers.
Yes, two main ones mentioned. First up is Comcast, ticker CMCSA.
Okay, Comcast. What's the thinking there?
Well, the idea is synergy. Comcast could potentially integrate WBD's studios and, crucially, all that HBO content into its own setup. NBCU and Peacock.
So it's about bolstering Peacock.
Exactly. It adds premium IP, maybe sports rights too, and that could really strengthen their streaming economics, and their advertising power.
Got it. And the second name that keeps popping up?
Netflix. Ticker NFLX.
Right. How would that work? It seems like a massive undertaking for them too.
It would be. An outright acquisition, or even just a deal for some key assets, would obviously give their content library a huge boost. More licensing power, too.
There's always a but, isn't there?
Yeah, the reporting is quick to point out that any big move by Netflix would likely face some really intense regulatory scrutiny. That's a major hurdle.
So for either Comcast or Netflix, the big prize is getting their hands on those key WBD franchises. You're talking HBO, DC Comics, Warner Bros., Pictures, that kind of stuff.
That's the core asset value, yes.
Yeah.
Owning that exclusive IP, it just gives you more leverage.
Leverage with who? Talent? Distributors?
Both. And it helps with those key streaming metrics everyone watches, things like ARPU, average revenue per user.
Right.
And reducing churn, meaning keeping subscribers from leaving. If you bundle must-have content like HBO, people are less likely to cancel. It makes your whole subscriber base stickier or more valuable.
Okay, so that covers the big strategic players. But these huge deals, they don't happen in a vacuum. There are financial firms involved too, right? Who benefits just from the deal itself happening?
Oh, absolutely. You've got the investment banks first, the classic bull bracket firms.
Like Goldman Sachs and JP Morgan Chase?
Exactly. Goldman Sachs, GS, and JP Morgan Chase, JPM, are mentioned. A transaction of this size. Think about the fees.
Advisory fees, financing fees.
All of it. Advisory, bridge financing if needed. Maybe fees for issuing new debt or equity later on. It's a substantial payday just for facilitating the deal, whatever form it takes.
And speaking of finance, let's go back to that $35 billion debt number. That complexity must create opportunities for other types of financial players, too.
It does. It makes the situation attractive for alternative asset managers and credit providers.
Okay, the reports name Apollo Global Management, APO, and KKR. What's their angle? Are they buying the debt?
Not necessarily buying all of it outright in the traditional sense, but finding ways to provide capital. WBD's complex balance sheet opens doors for private credit, structured financing deals, maybe preferred equity investments, or even putting together consortiums.
So specialized financing where traditional banks might hesitate?
Precisely. These alternative managers like Apollo and KKR thrive in these situations. They can structure deals that offer them potentially quite attractive yields for taking on that complexity and risk.
So they're not betting on the next Batman movie. They're betting on getting paid for providing the complex financing needed.
That's a good way to put it. They're financial engineers, not studio heads in this context.
Okay, let's pivot. Who faces more pressure if WBD ends up with a stronger owner, say Comcast, or even just gets its finances shored up by someone like Apollo? Who's on the losing end?
Well, the immediate group facing more heat are the rival streamers. Walt Disney, ticker DIS, and Paramount Global, PARA, are specifically called out.
And the logic there is just increase competition.
Yeah, basically. A combined WBD Comcast or even just a financially stronger standalone WBD really ramps up that content arms race we talked about.
For everything, series, movies, sports.
All of it. Premium series, films, those valuable sports rights. It likely means higher costs for everyone trying to acquire subscribers. Bidding wars for the best IP could get even more intense.
So it forces Disney and Paramount to potentially spend more, hurting their margins.
Or risk falling behind on must-have content. Yeah, it puts them in a tougher spot.
Okay, besides the direct streaming rivals, the reports also mention potential trouble for two other kinds of companies. First, legacy cable players, the ones without massive streaming arms.
Right. Think pure-play cable networks. If WBD gets a stronger owner who's really focused on integrated streaming bundles, it potentially weakens the negotiating position of traditional cable distributors further.
Accelerating cord cutting, basically.
It adds to that pressure, yes.
Yeah.
You can squeeze the affiliate fees these networks rely on and maybe hurt their ad revenue too.
Affiliate fees being the money cable companies pay the networks each month per subscriber.
Correct. And the networks mentioned here are AMC networks, AMCX and Cable One, CAVO. Fewer cable subscribers means lower fees. And if the big content bundles shift more towards streaming, these guys feel it.
Got it. And the second group facing pressure, smaller broadcasters.
Yeah, particularly those who rely heavily on advertising dollars, like Fox Corp, FOXA, and News Corp, NWSA.
How does WBD getting stronger hurt their ad business?
It's about the consolidation of premium advertising inventory. When a major player like a combined Comcast WBD or even a strengthened WBD offers advertisers huge reach across streaming, movies, maybe sports.
The big brand ad budgets follow the eyeballs.
Pretty much. It can draw those big budgets away from smaller, less diversified media outlets, especially impacting the scatter market.
Remind us what the scatter market is again?
That's the ad space, bought closer to the actual air date, often last minute. Can be quite volatile.
So if the big consolidated players lock up more premium ad commitments up front.
It leaves less for the smaller players scrambling in the scatter market, making their ad revenue potentially less predictable, more volatile.
So wrapping this up, WBD has a few paths here. A full sale, selling off pieces, maybe that split they talked about before between studio streaming and the cable assets. The path they choose really determines who gets the biggest rewards and who feels the most pain.
Definitely. And it's important to remember that there are real risks here that could slow things down or even change the outcome.
Like what? Antitrust is one, right? Especially if Netflix got seriously involved.
For sure. Antitrust review is a big one. Then there's just the sheer complexity of pulling off a deal this size, integrating or splitting up a company with so much debt.
And the price tag itself. The report suggests WBD's board might want quite a bit more than what initial feelers indicated.
That valuation gap could be critical. The buyer's looking at the debt liability, the seller's focusing on the asset value, HBO, DC, etc. Bridging that gap isn't always easy or quick.
Absolutely. Well, we appreciate you coming along with us as we look through this WBD situation.
And as always, we need to state clearly, the discussion of stocks, tickers, and any company's financial prospects here is based purely on the analysis and opinions in the material we reviewed for this segment.
It's for informational purposes only.
Correct. It should absolutely not be taken as financial advice or any kind of recommendation to buy or sell securities. Please do your own research.
And one final thought to leave you with. What if that valuation gap doesn't get bridged? If the big strategic buyers balk at the price and WBDD has to push forward with its own difficult restructuring under that $35 billion debt cloud, could that period of potential weakness actually give rivals like Disney or Paramount an opening? Maybe a chance to lure away key talent or snag content deals without a bidding war? Something to keep an eye on down the road.